Good afternoon. This is Josh Mindlin here at Chaikin Analytics, and I'd like to welcome you to our presentation of how to create a consistent income stream with options trading. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, along with Tony Zhang, chief strategist at OptionsPlay. Jaqen Analytics is not registered as a broker-dealer or investment advisor either with the U.S. Securities and Exchange Commission or with any state securities regulatory authority. Jaqen Analytics is for educational purposes only and is not a trade advisory service. Past results of any trading system or methodology do not guarantee future results. As a reminder, this webinar is being recorded and a copy will be sent to all registrants. Please submit your questions via the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. To get us started, here's Marc Chaikin.
Thank you, Josh, and welcome everybody. In addition to giving you some ideas on how to generate income with options, we're also going to show you how to use options to trade on the downside. And in a couple of minutes, I'm going to introduce our partner, Tony Zhang from OptionsPlay, but I'd like to welcome him because it's always a great treat for our Chaikin Analytics community to have Tony share his thoughts on options trading and insights into what OptionsPlay is all about and why he created it. So with that, for those of you who are not familiar with me, a little bit of background. I've been on Wall Street for 50 years. I've been using technical analysis for 45 years, but always in conjunction with fundamentals. For 5 years, I headed up the options department at a major regional brokerage firm, Tucker Anthony and R.L. Day. Over 250 brokers, tens of thousands of options traders, and sadly, 95% of those options traders lost money. And we're going to share with you the reason why and what Chaikin Analytics and OptionsPlay do to solve that problem. Along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were colleagues and some of them were clients. And the reason that's important is that when I came out of retirement in 2009 to form Chaikin Analytics with my wife, Sandy, I drew on everything I had learned from these successful institutional investors where I was teaching them how to use technical analysis to create the culmination of my life's work, the Chaikin Power Gauge rating, which is a fundamentally driven quantitative model. And it's really the heart of the success that we've had at Chaikin Analytics and more importantly, that our clients have had. So with that, I'd like to introduce our partner, Tony Zhang. Tony, why don't you give people a little insight into your background?
Thank you, Mark, and thank you everyone for joining me this afternoon. Like you said, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I've spent the last 10 plus years of my career in financial services, primarily working as a market strategist, starting out helping people understand the markets, understand what's currently going on and how to trade that. And that really is how I got started in this industry in trading and sales. And through that process of working with clients that are trading different markets across FX, equities, and options, I learned a lot about how people interacted with the markets, how people analyzed the markets, and that's really how we came about to starting OptionsPlay, because we realized options trading was very complex, it was very data intensive, and people didn't really know how to go about analyzing these strategies properly. And as traders ourselves, we realized that a lot of the work that we were doing day after day was a lot of manual stuff that could have been automated. And that's really how we came about to starting this company, is to make options much more accessible by making it visual as opposed to data intensive, and showing you guys analytics as to which strategies are best without having to be overly complex with languages and data, if you will. And that's really how we came about to creating this company. And working with clients over the last 13 years of all different types of strategies, one of the things that we wanted to show you guys is how easy it is to use OptionsPlay to find strategies And more importantly, the combination of what Marc is going to show you guys today, the fundamental and technical analysis that he's created, how you can leverage that with OptionsPlay to find explosive option strategies for both bullish and bearish views, as well as generating income for those of you that are currently invested in some of these stocks, how to generate some additional yield on your portfolio by selling cover calls. We're going to cover all of those things here today.
Thank you, Tony. And really what resonates with me is options for the rest of us. Chaikin Analytics is fundamental analysis for the rest of us, and it's probability based. And so is OptionsPlay. And the combination has proven to be very, very popular and very successful for our clients. So in today's webinar, we're going to show you the 5 keys to successful options trading. Starts with finding the right stocks to trade on the long and the short side. So bulls and bears with Chaikin Power Gauge rating for fundamental analysis and relative strength to the market for technicals. I'm going to show you a very unique way to use Chaikin Money Flow. I know many of you are familiar with Chaikin Money Flow. In fact, if you are, type a big C into the chat box, please, through your online brokerage platforms, and if you're a professional, through Bloomberg or Reuters. So there's a lot of stuff that's been written about Chaikin Money Flow. I'm going to show you a very different way to use it to predict big price reversals. So Josh, do we have a lot of people who are familiar with Chaikin Money Flow in here?
Yes, please use the Q&A window to type that in.
We have, sorry.
That's okay. That's why I'm here. Yes, we got a bunch of a couple Y's for yes and some C's in as well. Yes.
Great. So we're going to show you how to use rules-based exits and entries, because obviously for options trading, that is critical. Also, how to play good defense. We're in a volatile market. It's quieted down a little since February and March, but in any kind of market, you need to avoid landmines because they can destroy your performance. And then finally, we're going to show you using OptionsPlay how to find probability-based options trades. Now, before we get started, I'd just like to give you a little bit of a market overview, put it in context so that I have a sense, A, of what you're thinking, and B, what we're thinking about the market. So another question for you. Are you cautious about the market here as we are just getting into the heart of earnings season, either because of volatility or because you think it's too high? If you're cautious, type a big C. If you're bullish and looking for the market to go higher, type a B in the Q&A box, please. And I'm going to sort of guess that if it's like our recent webinar polls, a lot of people are cautious here. We've gotten people who say, well, I'm getting out of the market. I think it's gone as far as it's going to go. And part of the reason is that we've gone from an uptrend on autopilot in 2017, where it was pretty easy to make money if you didn't second guess the market or get influenced by the headlines, to a roller coaster of a correction here in 2018. So Josh, what are we seeing? A pretty even balance, or are the bulls in control here today?
Actually, more caution than not cautious at this point, probably by 60-40.
So that's why I want to start with the market. Let's look at the SPY. This is the Select Spider Sector ETF that mirrors the S&P 500 large cap index. Now, as we'll see later, large caps have lagged small caps here in the last month or two. But this chart, which is a one-year chart of the SPY, shows a couple of things. A, it shows that the uptrend is still intact, and this is the intermediate uptrend from the retest of the lows back in March. And actually, we've broken through the upper trend line. In terms of the SP 500, we closed at 2810 today, so we got through that 2800 resistance level, and the SPY closed above 280. So we did form a W bottom in February and then retested that in March, April. And if you look at Chaikin Money Flow, which is right under that, you see that when we got oversold here about a week and a half ago, Chaikin Money Flow was positive. That's a very bullish pattern. We saw that all through the uptrend. And as we've gotten overbought here on a short-term basis at the 2800, 2820 level, Chaikin Money Flow is still positive. So we're in a bullish climate. I believe that there are opportunities on the upside. Second quarter earnings season is going to be just killer. In the first quarter, we had a lot of sell on the news mentality in April. But if in spite of that, you're cautious or bearish, you should consider something that Tony's going to describe in a little bit, vertical put spreads, an alternative to just buying a put outright. Now, when I did a webinar on 6/26, there was a high probability vertical put strategy that OptionsPlay identified on the right, but the market was oversold. So my response then was, if you're bearish on the market, the timing is wrong. That was on 6/26, just 2.5 weeks ago, to put on a bearish position. So Tony, I'm going to ask you to come in here, and then I'm going to shift to the next slide once you've sort of described what you're seeing on the screen there and how timing can often trump high probabilities.
Yeah, so what we had here was, at a time on June 26th, S&P was trading around 271 right there. Buying an at-the-money put was about $450, or slightly over 2%, versus a put vertical was 255, slightly under 1%. So extremely, extremely cheap protection that you could buy. And usually when markets are that cheap, it's the market telling you something. Market's telling you that there's a very low likelihood that the market will continue going lower, and that's what we saw during those oversold conditions. Versus now, now we are still seeing similar type conditions, because as you can see, puts are still very cheap compared to the current price of 278. You're talking about buying a 45-day at the money put for just a little over 1% of the underlying, and a put vertical well below 1%. So extremely cheap to buy protection. So depending on whether you feel that there's a high risk of a pullback, the conditions here are a little different than they were on 6/28. Markets are closer to the top of the range. So if you even expect a modest pullback, buying some cheap protection that costs you less than 0.7% certainly is a cheap way to potentially protect your portfolio if you do, even if you're concerned about a small correction.
And in this case, all you'd need is a 4% drop from this. Of course, the market's rallied subsequent to me creating the slide this morning, but roughly a 4% drop with a 9-point spread gives you $700 of profit potential for a $200 insurance policy. In essence, you could protect a $250,000 or $280,000 IRA for a month and a half, because this spread expires on August 31st, by buying 10 of these spreads. So for $2,050, you can stay completely long the market and don't have to worry about an August pullback, which we often encounter. And if you're a speculator, obviously 3-to-1 odds are pretty good, and we're now overbought. So that's part of what we're going to talk about in this webinar, how important timing is. OptionsPlay finds you the high probability ideas. Timing is also critical. So here's the most likely scenario for 2018, and why I encourage you to reconsider being cautious. We're in a very bullish environment, higher interest rates and rising earnings. Don't be swayed by the headlines that tell you that interest rates going up are bearish for the market. When interest rates go up because the economy is strong, because earnings are rising, that's bullish. It can go on for a long, long time until the economy finally gets overheated. Now, there's lots of headlines telling you flat yield curve, very bearish, global slowdown, not happening yet. None of the indicators we monitor that have predicted a recession over the last 50 years have kicked in. They're almost comatose. So I'm personally bullish, and we do have second quarter earnings reports coming out. Now, as I said, first quarter, yeah, definitely a sell on the news mentality. You just come off that wild, volatile roller coaster ride. I was just quoted on CNBC.com this afternoon as saying, I think, the earnings will come in very strong, and we will not see that sell on the news mentality. You may get a little bit of profit taking, but then these stocks, as some of the banks did today, will start to regroup. So remain bullish. So that's the context for some of the examples we're going to see. Now, when I look at traders and why they make or lose money, for me, it boils down to focus. To be successful trading options, you need to be focused. Whether you're generating income or whether you're speculating, you need to focus in on the right opportunities with the right methodology. But the biggest problem there is too much information. We're always confronted, both in our personal lives with Facebook and Twitter and LinkedIn and email, with a lot of information. Same is true on the investment side, particularly if you're an options trader. So our solution to information overload is Chaikin Analytics for iPad and desktop. We've integrated OptionsPlay in. It's almost 3 years now. And once I go through the Chaikin Power Gauge, which is our go-to fundamental indicator, Tony's going to take over a lot of the heavy lifting on the options side. So Chaikin Analytics now being used by some of the most well-known and successful traders and investors, including John Najarian, Jim Cramer, John Carter from Simpler Trading. So we've really had a big outpouring of love for the Chaikin Power Gauge rating. And the reason is it's worked since it was rolled out in 2010. Underlying our whole philosophy is the concept that fundamentals drive the market, but emotions drive the market to extremes. The big institutional investors, the mutual funds, the hedge funds, the quantitative investors have the assets in the cloud to move the market. But we use technical analysis to measure the extremes and profit from them. So the path to profits in options trading, in my view, is to combine fundamentals and technicals. The problem is, how in the world can you do the fundamental research or find fundamental research that you are confident in? Even some of the advisors who are clients of ours are suspicious of their firm's research. They're looking for third-party validation, for a check on it. For individual investors, it's very time-consuming. So I created the Chaikin Power Gauge rating in 2010 to do the fundamental heavy lifting. It's a simple display in Chaikin Analytics. We show it as a gauge. Looks like the gas gauge on your car. Goes from very bearish to very bullish. And in spite of that simple display, there's a lot of powerful number crunching going on under the surface. I've said before on these webinars that the Chaikin Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. And during earnings season, it can be your GPS, because companies with a bullish rating are more likely to report a positive earnings surprise, and companies with a neutral or bearish rating are likely to report negative earnings surprises. Now, what Chaikin Analytics and Chaikin Power Gauge rating does is cut through the clutter. All that data on the right is what fundamental analysts use to make their recommendations. We've synthesized all of that down to a gauge. This is an old Power Gauge rating from a year ago on Lam Research, and 4 principal factors. And John Carter, who's one of the best pure traders I've ever known, about 2 years ago came in contact with the Chaikin Power Gauge rating and immediately responded to it. He said, this is an objective, awesome meter for stocks because it combines 20 plus technical and fundamental factors to anticipate a stock's potential. And he said this Chaikin Power Gauge rating is really an awesome meter for stocks. So what is it that got John Carter so excited? Well, the Chaikin Power Gauge rating looks at 4 primary factors that cover value, growth, technical, and sentiment factors. And within each of those, there are 5 sub-factors. Now, these 20 factors are based on working with institutional investors for over 30 years. To sell my technical analysis package, a company that we ultimately sold to Reuters, I had to learn what they were looking at every day. And in doing that, I came away with a sense that successful investors look at the same things every day in the same way. That's that focus that makes them successful, but that there are different styles and time horizons, from the value investors here in the Philadelphia area to the growth investors in New York and Boston and parts west, to the quantitative strategists, hedge funds with very short time horizons. The common thread was they all looked at the same factors that were important to them every day. So the power gauge rating works because it's based on how Wall Street works. It wasn't developed by some PhD with a theoretical model that didn't stand up to the test of time. That's what got us in trouble in 2008, the financial collapse, and then 1998 with long-term capital management collapsing, Nobel Prize winners coming up with models that didn't work. This model works, and it has since it was locked down in 2010. And I've boxed some of the important factors here because we're in earnings season. Earnings surprise is really critical. And when companies report better than expected earnings, normally leads analysts to raise their earnings estimates. And the reverse is true. When they report negative earnings surprises or guide lower like Netflix did, analysts start to lower their estimates. Short-term stock trends are driven by analyst estimate revisions. So the model has longer-term value factors like price to sales and free cash flow, which is what Warren Buffett looks at, and then shorter-term factors that are more sensitive to what Wall Street analysts are doing and saying. And then, of course, I love industry group relative strength, puts the wind at your back. We don't have time to cover that in depth in this webinar, but you'll see examples of stocks where the bullish stocks are in strong industry groups and the bearish stocks are in weak industry groups. It just improves your trading to be on the right side of industry group relative strength. So with that, what's the performance of the power gauge rating been? Well, using the Russell 3000 as the universe, over 18 years through the end of 2017, the very bullish stocks have been up an average of 20%, and the very bearish stocks have been up only 1%, and that's after a 9-year bull market. So what we're trying to do on the long side of our options trade is focus on the very bullish stocks, and on the short side, the very bearish stocks. But in 2015, it was really important to have a tool like the power gauge rating. Why? Because small cap stocks and energy stocks were in their own bear market. They were down at one point almost 28%. The average very bearish rated stock in the Chaikin power gauge methodology 2015 was down 17%. These were the Kinder Morgans of the world, Range Resources, the fracking stocks, the energy stocks, small caps in general. You had to know which stocks had bearish ratings to avoid them, to sidestep the 80% drop in Kinder Morgan from 42 down to 10 and change. Because that is a trap that a lot of investors, both individual and professional, fell into. So one final proof point, and then we'll move on to some really meaty examples and bring Tony back in a couple of minutes. Chaikin Power Gauge drives 2 exchange-traded funds based on NASDAQ indices that have 4.5 years of real-time live track record. In less than 18 months, they've garnered $1 billion in assets, large cap and small cap. As Josh said, not a recommendation to buy the ETFs, just validation that this really works. I can show you all the performance charts in the world. You've got 2 exchange-traded funds, each with almost 500 million in them, and that's hard to do. Even Mr. Wonderful, Kevin O'Leary, only has about 420 million, and he's on CNBC every day. Smart as a whip. These ETFs are successful because they have a history of performance. So let's zero in on one of the most important patterns for making money in stocks and options, swing trading and long candidates for options trading. We call them classic Chaikin bulls, and there are 3 pieces only. Power gauge rating is bullish. That means the fundamentals are strong. The stock is outperforming the market, and we'll explain to you why that's so important. And Chaikin money flow, which measures institutional buying and selling pressure, is strong. Now, we're going to use a 1-year chart of Centene. We've been using Centene for over 6 months as our poster child for the classic Chaikin bull, and we do something different at Chaikin Analytics when we look at a chart. We read the chart from the bottom up. Why? Because the power gauge rating at the bottom of the screen on this 1-year chart is your go-to fundamental indicator. It's your directional edge. The directional edge that gives you solves the problem that 95% of options traders have. They don't know where a stock's really headed. They're attracted to it because of volatility or a news event. First thing I look at is the power gauge rating. Is it bullish if I want to trade this stock on the long side? Then one up from that is our unique way of looking at relative price performance. We compare a stock to the S&P. It's a heat map. If it's outperforming, it's green, and that means the market agrees with the model. Very critical. No matter how good your fundamental research is, whether you're Merrill Lynch or Fidelity or Chaikin Analytics, if the market doesn't agree with you, guess who wins? The market always wins. My old friend Marty Zweig, who sadly died way too young, used to say, Mr. Market always wins. Don't fight the tape. Then we look at Chaikin Money Fluid to see if the institutions are accumulating the stock. And in the case of Centene, back in September, October, November, huge institutional accumulation. So that's the way we look at the chart, and then we look at price action to make sure the stock is in a good trend. And then the final piece of those buy and sell signals, in this case, are relative strength buy. So everything you need to know about a stock is on this chart, including earnings information and a lot of the other stuff you want to know. Now, in the upper right-hand corner, we summarize the technicals. They're strong, the trend, and the industry group, in this case, medical care. So there's where industry group comes in. But it's all there for you, and then you see the options button. You click that, and as Tony will show you, you'll get the options play probability-based strategies. So this is our classic bull. In the upper left-hand corner, you see a yellow triangle. You click on that, you can make notes on a stock. That's really a powerful way to keep track of what you were thinking when you went into a position, and it's a great way to learn from your mistakes and reinforce the good things that you're doing. Now, it's one thing to know that there's a great pattern that works, the classic bull, but how do you find them? So we give you a screening tool that goes way beyond what other screening tools do, and that is the ability to screen on the power gauge rating and the factors in it. So in this case, this morning I was looking for large cap growth stocks. I think large caps are going to start outperforming small caps here. They've been lagging because earnings are going to come in on average 20% higher for the S&P 500 in the second quarter. So I took a universe of large cap growth stocks, 529 of them, required that the rating be bullish, and then I just added one factor to the money flow and relative strength that we've looked at. And that one factor was free cash flow. I wanted free cash flow to be strong because I want stocks that are solid financially. So narrowed a list of 529 names down to 12. That becomes my bullish watch list. I'm looking for buying opportunities. So Centene happens to be on there. Expedia, a stock which has recently turned around in the internet media space, very strong. Disney, Citrix, we're going to look at later. So this is my list of 12 buy candidates. I can monitor them for signals, as we'll show you later. And here's Expedia. Gave a buy signal just about 2 weeks ago when the stock dipped under 120, and it's rallied up to 128 today. So this is that focus I'm talking about. If you have a very small list of stocks, if you had done this screen 2 weeks ago, Expedia would have been on there, and then you would have seen that buy signal in an alerting email that we have on your list. So large cap buy, very profitable. When it dipped down, Chaikin money flow stayed green. That's a very bullish situation. Should have gone red because this is meant to oscillate. So very, very positive pattern. Classic Chaikin bear. Turn everything I said upside down now. Power gauge rating is bearish. It's underperforming the market. Chaikin money flow is red, not green, telling you that the institutions are selling the stock. So again, we read the chart from the bottom up. The power gauge rating is bearish. It's confirmed by weak relative strength. So the market agrees with the model. And back there in November through February, institutions selling to Saro, which is a drug and biotech stock that's gone from 125 down below 40 in the middle of a bull market. Weak trend, weak industry group, all three of the key Chaikin indicators bearish, and then we have our relative strength sell signals. Now, I'll explain this signal to you because it's powerful and it's great for options traders. A stock that's underperforming the market goes above its 21-day average and then dips back below it. That triggers the relative strength sell signal. If the power gauge is bearish, it's even more powerful. And the reason I like this signal for options trading is these signals have a duration of 4 to 8 weeks. They're about 70% accurate, and they last 4 to 8 weeks, which means you can put on option strategies that don't suffer from time decay. Tony's going to talk about that in a minute, and ride out some of the little oscillator moves and get the big moves. So it's a great way, if you're trading options on the long or the short side, to put on a really intelligent option strategy. And notice how, in spite of takeover rumors back here in June, the stock continues to make new lows. So with that having been said, I'd like to bring Tony in to talk about OptionsPlay and also walk you through some examples.
No, thanks, Mark. So the primary use case of OptionsPlay in conjunction with what Mark just showed you was how do you actually find option strategies if you're bullish or bearish on any given stock. And what we want to do is display 3 instant strategies for either bullish or bearish views on any given stock or ETF instantly to you. And the 3 strategies that we display represent the 3 most popular strategies that someone would trade on either a bullish or bearish move. So if you're bullish, we would present to you buying the stock, buying a call, which is a simple option strategy, and buying a call spread, which is a more complex option strategy. And these 3 are instantly provided to you without you having to select any expiration dates or strike prices or your strategies. And they're all optimized for you as a starting point for the strategy, for the stock that you're looking at. This way you can start exploring for those of you that are brand new. And for those of you that have some experience trading, this is designed to save you time, because if any of you have ever pulled up an option chain, you'll know that you spend quite a bit of time first figuring out what strategy should I trade, then figuring out which expirations, which strike prices. And a lot of times it's more of an educated guess more than anything, versus ours is already optimized based on probabilities so that you know that the starting points that you're provided with make sense so that you can start analyzing and fine-tuning them. So we have a few different panels that are designed to help you fine-tune them. However, the most important one actually is the one on the right, the P&L simulator. Because when you're bullish or bearish on a stock, you typically have a target price, or at least you have a view as to where you think that stock's going to go. And it's really important to compare different strategies side by side. So if you're bullish on Centene and you think it's going to go up 5%, well, should you buy the stock or should you buy the call? When you're looking at an option chain, it doesn't tell you that. You can't calculate that by looking at a chain. Our P&L simulator not only allows you to simulate any given outlook on the underlying stock, but more importantly, tells you exactly how much profit or loss you would expect from each one of the 3 strategies. And this way you don't have to learn about delta, gamma, theta, vega, all the Greeks that you typically need to do back of the envelope calculations to figure out what your potential profit or risk is. We do all of that for you. So it really makes the whole process of finding and researching and analyzing an options trade as simple as possible.
And of course, in the Chaikin Analytics community, there are a variety of ways that people have found to use OptionsPlay, and here are just a couple of them. Why don't you go through that, Tony?
Yeah, so I think the options play, speaks to two audiences very well. For those of you that are brand new to options and starting out, and you find the terminology and the data just a little too complex and overwhelming, that's really what we designed this for. We call it options for the rest of us, to help all of you that are brand new get started without feeling overwhelmed and feel that the data is too intensive for you to analyze, because we present everything to you in a visual format. Everything is color coded so that you know what's good, what's bad. Unlike an option chain, it's just a wall of numbers, and it's really difficult to discern what's what. One thing from another. And for those of you that have some experience trading, this is really designed to save you time, because as a trader myself, I used to spend a lot of time pulling up the chains. And what I realized is I was going through the same motions every single time. If I was selling a cover call, I would always be looking for that 30-day, 20 delta option. And if I was buying calls, I'm always looking for that 45 or 60-day option at a 60 delta. And all of this work I was just doing manually over and over again. And we realized that, hey, we could save a lot of time if there was some kind of program that we built that just instantly returned the starting points that we typically like to use. And that's really how we came to produce options plays, providing everyone with that starting point that we would use as traders, presented to you in a visual format, and for those of you that are brand new, giving it to you in plain English. So if you've ever looked at an option chain before, you'll see things like delta, implied volatility, and all of these different terms that you might not understand. We translate all of that into plain English. So if you've never heard of what a call vertical is, we'll explain to you what that strategy is, what the stock needs to do in order for that strategy to be profitable, so that you can understand these trades before you place it. And that's really the key thing here, is understanding your risks and rewards before you place a trade. And options really help you define that. And that's really why I personally like to trade options. Unlike buying a stock, sometimes you buy a stock and you just hope that it goes up, and you don't really have a time frame or a target in mind. Options really give you that sense of exactly what your expected profit or risk is before you get into a trade. Hey, Mark, is this slide for you?
Oh yeah, sorry, I didn't go off mute. I'm a firm believer that to trade options successfully, you need a disciplined methodology. So at the top of the pyramid, very bullish, power gauge rating if you're on the long side, with industry group strength supporting it. The bottom of the pyramid, just two technical indicators, Chaikin money flow and Chaikin relative strength. And then right in the middle, that sweet spot, done for you options ideas using OptionsPlay. So with that in mind, let's let Tony explain some of the sort of basics of option trading, and then we'll give you some specific strategy ideas for the here and now.
Yeah, so this slide is for those of you that are starting out with options. The simplest of option strategies is buying a call or a put. And the easiest way to think of this is buying a call is useful if you think the stock's going to go higher. Buying a put is if you think the stock's going to go lower. This compares to, if you're bullish on a stock, you'd buy the stock. Here you buy a call option. If you're bearish on a stock, you traditionally, the only thing you'd be able to do is short a stock, provided that stock was shortable. When you're trading options, you can actually buy a put option. The great thing about both of these strategies is that they have limited risk. When you buy a stock, you have the risk that the stock goes to zero and you lose everything. When you buy a put, when you short a put, or short a stock rather, you have the risk that the stock runs significantly higher, and you actually have unlimited risk. So both of these strategies put substantial amount of capital at risk to take a bullish or bearish view on an underlying stock. So a call or a put option is an alternative that allows you to get that same upside if the stock goes all the way up to infinity, or if the stock goes all the way down to zero. A call or a put allows you to take advantage of both moves while maintaining a limited amount of risk, so that no matter what happens, the risk that you have is limited to how much you've paid. And an important concept to understand when you're buying a call or a put option is that there's an expiration date. Unlike stocks, you can buy and hold on to indefinitely. When you're buying a call or a put, you have a date at which the call or put will expire. And the cost of that call or a put will actually decay in value as you get closer and closer to that expiration date. And that decay, what we call time decay, will actually accelerate as you get closer and closer to expiration. So one of the key things about buying calls and puts is managing that time decay, which is why we usually like to go out at least about 45 days when we're buying a call or a put option. So we try to minimize that last 10, 15 days of time decay. We want to minimize that by going further out in time when we're buying a call or a put option. Another way to offset this a time decay is by trading a more complex strategy called a vertical spread. This is where you're buying one call, but at the same time selling another call against it, or buying a put and then selling another put against it. And the reason for this is because when you're buying that call, it costs you money or a debit to get into that trade. To sell that call or a put against that, you're actually bringing in some premium. And that helps offset the cost of the trade, which lowers your absolute risk on the trade. And that short call or a put will actually start offsetting that time decay as well, which allows you to stay in that trade a little longer and mitigate that effect of time decay. So that's really one of the more popular strategies amongst more experienced options traders that allow them to give them that directional exposure to either bullish or bearish views without having as much time decay working against them, and also at the same time minimizing their downside risks.
So let's look at one of the stocks that I've been negative on because the power gauge has been negative for well over a year. That's extremely difficult to trade on the short side. This is Tesla. It's a one-year chart. The power gauge is bearish. It's under its long-term trend, but it's been highly volatile. Typically, we've had our best luck with Tesla when we use vertical put spreads when the stock has triggered these relative strength sell signals. We're now in a position where that's going to be hard to do, and yet this may be a wonderful bearish opportunity heading into their August 1st earnings report, and I know that because that's right there on the screen. So weak stock in a weak industry group, not the ideal time to be putting on a bearish position, but Tony, why don't you explain what the OptionsPlay module is showing here on Tesla?
Yeah, so Tesla's trading at around 315 right now. So if you wanted to short the stock, you need a substantial amount of capital to do so, let alone a huge amount of risk if Tesla does somehow they end up beating on earnings and the stock trades higher. A much better way to potentially play a bearish view on Tesla going into earnings is buying that put. So as you can see, to buy 100 shares of this stock costs you roughly $31,000. To buy a single put only costs you $2,500. That gives you the same exposure as shorting the stock, but only putting $2,500 at risk versus substantially more capital. Versus that vertical on the right actually only costs you $1,600. So substantially less risk even compared to buying that at the money put. So that means that you can basically take a bearish view on Tesla to the downside, only costing you roughly about 5% of the underlying, which is quite cheap. And this provides you a nice 184% return if the stock goes down to around 270 on earnings, which is not that crazy of a move on a stock that's as volatile as Tesla. For it to move down to 270, as you can see, it's right near that low that it was trading at just about 2 months ago. So I think that this is, if you're bearish going into earnings on Tesla, this is an interesting way to play that with a limited amount of risk. And that's the key thing here, is when you're trading earnings, you never know where it's going to go. So you want to limit your risk as much as possible. And the best way to do that is using these vertical spreads.
And of course, we saw today when Netflix opened around 345, down from 400 on actually an earnings beat, but very disappointing customer acquisition numbers and guidance that was lower. Highly valued or richly valued stocks, when they disappoint, are like being on a high wire without a safety net. So I'd like to step in and do 3 patterns here before we get into some more specific income ideas. These are patterns that have worked over and over again for the members of the Chaikin community over the last 6 years. We call them the dynamic duo, spotting personality changes, and then that unique way to look at Chaikin money flow, which monitors stealth accumulation and distribution. So what is the dynamic duo? It's the combination of fundamentals and technicals that we've been talking about. Chaikin power gauge rating for fundamental analysis, does the heavy lifting for you, and the relative strength heat map indicator for the technicals. It helps you find big winners and losers when they agree with each other. With one exception, relative strength stands alone as a bullish or bearish indicator. Now, what we mean by that is there are stocks that gather high momentum. Traders love them. Netflix is a recent example. The fundamentals are just off the charts in terms of valuation, 280 time PE ratio, but yet the stock has been a big winner until today, and that highlights the biggest risk in trading these high momentum stocks. If the fundamentals don't support it, you're on a high wire without a safety net. When something goes wrong, as it did today in Netflix, or when the news turns sour, as it did for Tesla with quality control issues when they try to get up to 5,000 units a day, the pain is intense. So here's an example of the personality change, which goes along with the dynamic duo. Personality change is defined as a stock that goes from outperforming to underperforming, or vice versa. And spotting personality changes is really the key to making and losing money in the market, because too often we put our feet in cement as traders, and knowing about personality changes is one way to be flexible. So here's an example of a bullish personality change in Macy's. Everybody wrote off the retail stocks in the fall and winter of 2017, but Macy's underwent a personality change. And we know that when the relative strength indicator goes from red to green, that's a bullish personality change. Now, you don't want to run out and buy the stock at that point. It's been in a downtrend, goes into an uptrend. You want to wait for the first buy signal. This is a concept we're going to look at over and over again in the balance of the webinar. When you've had a personality change, don't rush in. If a stock breaks above its upper volatility bands, don't chase the momentum. Never pays to chase. 1 in 5 times you may make out. Wait for that first buy signal. In this case, it's that relative strength buy signal. And notice that there were 3 additional signals after that that have all worked out beautifully. So bullish personality change with a bullish power gauge rating. You've got the dynamic duo working for you, in this case, strong industry group, and those buy signals are your options entry points. Now, here's a chemical stock in the S&P 500. Albemarle had a bearish personality change in December when it went from outperforming to underperforming the market. Power gauge rating was bearish. The institutions were selling the stock, so those are our 3 go-to indicators. And then when you get those sell signals, particularly ahead of earnings reports or guidance, you have to pull the trigger. That's that relative strength sell signal that has that 4 to 8 week time horizon. So absolutely critical, even in a bull market, to know that there's been a bearish personality change. Now, that first sell signal after the bearish personality change is your entry point. And in this case, we had 2 of them. The first one is on the left, then we had a second one on the right. Now the signal that you haven't heard described anywhere, unless you've been on a previous Chaikin webinar. We call it the secret sell signal that 95% of traders never see. It's a bearish money flow sell alert based on Chaikin money flow. So we're going to go back in time to advanced auto parts, to January of 17 through roughly October of 17. Advanced Auto Parts was one of those momentum stocks that gapped up and kept going for about 2 months. And when it equaled that previous peak back in January of 2017, Chaikin money flow should have gone green or positive because the stock was making a new all-time high. Instead, it stayed negative because the institution, smart money, was selling not just advanced auto parts, but all the auto parts stocks. So there's a progression here. You could have gotten out at 170 if you were long, thought about going short, but safer to wait for the bearish personality change, which followed suit about a month later, and then the power gauge going bearish, because now the dynamic duo is weak. The institutions are selling the stock, and you wait for that sell signal, which came at around 140 on the way to a low of 78. Didn't pay to bottom fish, just follow those signals. Big profits from the relative strength sell signals. When you've had that money flow sell alert, you're on notice. If you're long the stock, just get out. And here's a more recent example, and I'd like you to look over my shoulder because this encapsulates what we've been talking about on both the upside and the downside. I recommended DR Horton in my weekly market insights when it pulled back to its 21-day average in September. The stock was 36.90. Reading the chart from the bottom up, power gauge was bullish. It was outperforming the market, and look at the institutional buying that was going on. And the stock went almost straight up from September through late December, with Chaikin money flow bullish almost all the way up until it made that final peak at the upper volatility band, and you got the bearish money flow sell alert. So if you were still long this wonderful home building stock, it's time to exit the party. I wouldn't have gone short at that point because Chaikin power gauge rating was still bullish and it was outperforming the market. But I want to get out of my longs, and I want to be leery of buying dips at that point. Interestingly, Barron's wrote a very bullish article on the home building stocks right in here as the stock was breaking its long-term moving average. And since that break, look what's happened. In spite of the bullish demographics for first-time home buyers, and that's what DR Horton caters to, relatively bullish fundamentals, this stock has been dead money all through 2018, and you started getting relative strength sell signals, and then finally the power gauge went bearish. Now, Tremble is a stock that both my partner, Dan Russo, our chief market strategist who writes our morning insights, identified as a bearish trade based on these overbought sell signals, which triggered what we call mini money flow sell alerts. The stock didn't make new highs at the upper band. It just got overbought above the 21-day average. And the oversold buys and overbought sells are really simple. Stock has a bearish power gauge rating, gets overbought, and makes an 8-day high. Money flow is negative. We call that a mini money flow sell alert. Smart money is selling the stock, and both Dan Russo and I highlighted this as a bearish opportunity in our respective market letters. So it works on new highs. It also works on rallies in stocks that are in a downtrend. And this is a very powerful pattern. If you take away just this pattern from the webinar, your trading is going to improve. And you can spot these in stockcharts.com or your online brokerage platform. The beauty of Chaikin Analytics, we combine the 3 key indicators and the signals all on one chart. Now, everything we've looked at is what Warren Buffett calls the fat pitch. He has famously said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. We call it the ideal setup. So to trade options successfully, you want the ideal setup, and then you want to pull the trigger. And for us, it's these 6 pairs of buy and sell signals. You may use candlestick patterns or crossing moving averages. That's fine. You have to have a disciplined entry methodology. Now, just as with the classic Chaikin bears and bulls, it's important to know how to find these stocks. So we give you 2 ways notification. We have a dashboard in our iPad and desktop apps. And in this dashboard from 3 months ago for a webinar I did, in a list that I follow, Adobe triggered a relative strength buy signal. It was 225, and look what happened to Adobe. Went from 225 in April to 260, vastly outperforming the market. And again, a series of relative strength buy signals Typically, they work 70% of the time. These 5 have all worked out. In fact, there's one at the bottom of the chart there on the left. So 6 signals all working out. If you want to trade more profitably in the options area, follow the signals, because if you're disciplined and it's based on proven patterns, it's better than trading on your emotions. Now, the second way, and this is a new service from Chaikin Analytics, to find these signals are our daily email alerts on a list of your choosing, and also on a broader list like the SP 500. Every morning in an email to all Chaikin members, we give you this alert email. Just 2.5 weeks ago, when I was doing a webinar on June 26th, only one stock in my list of about 40 triggered a signal. That was Citrix. Triggered an oversold buy at 104, and with very positive Chaikin money flow, all 3 of our key indicators, reading from the bottom up, power gauge, relative strength, and money flow, positive, gave you that oversold buy signal on a new 8-day low, and the stock has rallied very nicely to the 110 area. So 104 to 110 in a market that's been sort of choppy as we're finally perhaps breaking out on the S&P. These are the kinds of signals that you need to make money trading options profitably. Now let's look at how you take advantage of volatility, profits in options and small caps. You follow the power gauge ratings. Industry group support for the trade is important. If you want to focus on small caps, OptionsPlay will find you highly rated strategies, and then use the rules-based entries. So here's a one-year chart of the Russell 2000, the IWM that a lot of you trade to get exposure on small cap stocks. And you can see that the uptrend is deeply intact, broke through that ceiling, which the S&P is just now doing, almost 3 months ago in early May, and made new all-time highs as recently as 2 weeks ago, with strong Chaikin money flow. So small caps have been outperforming large caps, and you want to find stocks like Fossil. Again, there's your example of a bullish personality change based on a very positive earnings surprise back here February. You don't want to chase that. You want to wait for that first buy signal. There's your entry point. So bullish personality change and first buy signal go hand in hand. And the stocks had a huge move from about $11 to $30. Obviously a very well-chosen example, but one that we found with our screening program. Now, if you were bullish on Fossil on this pullback, the first oversold buy gave you a nice little rally from 26 to 30. Now you've pulled back, completed a little 3-wave pattern, found support at the lower volatility band. Here's what OptionsPlay found. And Tony, you might just want to quickly recap what we're seeing here.
Yeah, this is a very straightforward, stock trading at $26 to buy 100 shares costs you $2,600. But instead of doing that, to take upside exposure, because it's had a pretty big run up, there's certainly more risk to the downside. Buying that call vertical on the right allows you to risk only $210. So less than 10% of the underlying. You can get the same upside exposure as buying the shares, but risking less than 10% of what you would if you had just outright bought the shares. That's really where you get the high performance. So if the stock goes up to that $33 target, you're making a 233% return on that call vertical versus only a 26% return if you had bought the stock. Not to mention, when you buy the stock, you have substantially higher risks if the stock does pull back. Here, no matter what happens, even if the stock goes to zero, you're only risking $210 for every 100 shares or every contract that you're buying.
So this is an example of good risk management and good money management combined. Using a small portion of your assets to control 100 shares of stock. You want to control 500, it's $1,000 instead of $13,000, and you know what your risk is. So never play with all your money in these types of trades. They give you leverage, so you can keep money either parked in stocks or on the sidelines. Now, another small cap stock that we've actually recommended on these webinars or talked about is Bluecora. It's in the business services area, very powerful move with Chaikin money flow extremely strong. And it gave that buy signal back in late April, early May, with the stock at the 24.50 level, and it rallied to 40. Pulled back, gave an oversold buy. So let's say you bought that pullback at 36, and you still like the stock, but you think maybe small caps are going to underperform. I do for a while. So here's an income strategy that Tony's going to speak to, where you can stay long Bluecora. And what happens in this strategy, Tony?
Yeah, so this is for those of you that own stocks that you're trying to generate some additional yield from that stock. And this is really useful if you have, if you plan on staying in the stock for a while, because as you can see, Bluecora currently pays a 0% dividend yield. So meaning if you own the stock, the only appreciation you're getting is from the capital appreciation of the stock going higher. You're not getting any yield just for holding the stock like you do with an AT&T or GE stock, where you're getting paid a pretty hefty dividend. Here, what you can do is you can sell a cover call against the stocks that you own to generate some additional yield. So as you can see, Bluecora is trading at 37 here. By selling this August 17th $40 cover call, which gives you the obligation to sell the call at $40 if the stock is above that, above $40 by August 17th, you're going to receive $130 in income over the next 30 days, which is roughly a 3.5% of the underlying stock that you're going to receive just in 30 days, which means that if you were able to do this month after month for the whole year, that's an annualized return of almost 40% yield. So that's why these types of trades are very, very attractive. And what you want to do is use them in conjunction with the Chaikin power gauge and the indicators that Marc is showing you. As you can see, this stock is really kind of pushing 40 as its high, and that you have that upper volatility band, which tells you that there's a low probability of this stock going above $40. These are the types of things that you can utilize to help you better pick your cover calls to really maximize your yield. And our tool will actually allow you to specify how far out you typically like to sell your cover calls. Some of you like to sell 1 month calls. Some of you like to sell 6 month calls. You can put in those preferences, and you can also select how aggressive you want to be, whether you're conservative because you want to keep that stock, or if you're aggressive because you just want to maximize yield. You can put in those settings, and we'll actually find you the cover call that closely matches your personal criteria. And that's really the key here. But based on our research, it's usually best to sell short-dated options because of that time premium slide we showed you before. Most of that time premium, most of the profits you make from cover calls happens within that last month before expiration. That's really why you want to sell shorter-dated options to generate as much yield as possible.
And in this case, I customized OptionsPlay because I wanted an option that was close to that upper band. The OptionsPlay module actually recommended, I think, the 42.5 call, but I was content to give the stock up at 40 and take in that huge premium. Now, I'd like to sort of get toward the end of the webinar with defense. The Eagles, as many of you know, won the Super Bowl, and even though there was a trick play on offense, it was the defense that held off the Patriots. And good defense in the stock market very often leads to good offense. So good defense is about the stocks you don't own, and also about the options positions you don't put on. And that's where both Chaikin and OptionsPlay come in. We help you know which stocks not to own and which options positions have a low probability. So you want to avoid weak industry groups. Don't bottom fish in weak stocks. Improve your performance by eliminating bearish rated stocks from your radar screen if you're trading on the long side, or from your IRA. You want to spot bearish personality changes and make sure you're out of those stocks, and look to buy put options on them or other weak stocks. So that's how you play good defense. Here's an example. Ambarella is in the semiconductor area. It's been a big high flyer until just recently when it's tanked. And we got an overbought sell signal right ahead of earnings at that upper volatility band. Great opportunity. Again, my partner Dan Russo picked this as his bearish stock of the day back in May and had almost instant gratification from 55 down to 42. You can also play good defense by writing covered calls. We just saw an example of that with Bluecora. Tony's going to give you another example after he gives you a brief primer on covered call writing.
Yeah, like I said before, covered calls is a great way to add yield to your portfolio, which provides you with a little bit of downside protection when the stock does sell off. So for example, going into earnings, if you want to hang on to a stock, but you're concerned about a pullback of the stock because of an earnings miss, selling covered calls, especially aggressive calls near the current price of the stock, is one way to help offset, any downside you have on the stock. And this is a great way to add yield for specifically stocks that aren't paying you any dividends. So stocks that you're hanging on to and you're just hoping for the stock to go higher, cover calls is a great way to add additional yield. And for those stocks that currently do pay a nice dividend, those are the types of stocks that typically aren't very volatile. So cover calls, again, also another way to potentially enhance your returns by selling calls against those kind of blue chip stocks that do provide you with quite a bit of yield already. And I think Intel's a good example of this.
Yeah, this is a great example because the blue chip stock in the semiconductor area, the biggest stock there, power gauge had been bullish. It was in an uptrend that was broken. And guess what? The Chaikin power gauge went bearish on June 18th. A major research firm on Wall Street, Bernstein and Company, said sell it on June 26th. It had already dropped from 52.50 down to 48 when they said sell it. If you were using the Chaikin power gauge, you would have been bearish on it. But if you're still long-term bullish on Intel, there's a income strategy that really works well here.
Yeah, so we were looking at the August 35th 55 cover calls, which still gives you quite a bit of room to the upside for the stock to go, but it gives you 1.3% of the underlying shares in the next 45 days, which annualizes out to a little over 10%. And so if you're selling these types of cover calls throughout the year, you're buying yourself effectively what is a 10% downside protection on a stock that may have a small pullback in the near future. So this allows you to stay invested in the stock while generating some income and providing and continuing to lower the cost basis of your stock so that you're not as concerned about small corrections.
Now let's contrast that to a buy and write where you actually go out and buy the stock and write the covered call. I don't recommend doing that in stocks that have recently had a bearish rating. I want to do that in bullish rated stocks where they're likely to go up so that I can keep my capital growing, not worry about scrambling on the downside. So this is a great strategy. And there was also a comparable strategy in a stock that the power gauges love now, off and on for over a year, Facebook. And this highlights what you have to do in a volatile market to make money in options. You have to be prepared to buy the dip. So here's Facebook with huge institutional accumulation, weathered the big privacy scandal back in February, gave us an oversold buy signal just about a week ago at the 192 level. And if you were fortunate enough to buy it at 192, you've now rallied to a new high here. Actually, subsequent to this chart, it rallied up to the 210 area when the FANG stocks rallied this afternoon. But let's say you think that that's perhaps a temporary peak in the stock. It's already overbought. Here's your covered right strategy, and I think it's a great one, Tony. What about you?
Yeah, Facebook, there's the tech sector, I think, has a lot of downside risk, especially after what we saw with Netflix yesterday. So this is a very attractive way to potentially hedge some of that risk because Facebook, again, is still a very bullish stock. I don't think many people that own the stock want to get rid of it at this point. I think there's still some upside, but there's certainly some downside risks. And that's why selling these cover calls going into earnings many times makes sense, because here, looking at the August 31st, 217.5 cover calls, which gives you another 10%, a $10 upside, gives you 2.1% of the underlying, which annualizes out to about 17%. So this is why giving yourself an extra 2% protection onto the downside is certainly good going into earnings, in my opinion.
So this is the best of Chaikin and OptionsPlay combined. You buy the stock, you pay about $192, it rallies up to the upper band. You consider selling this covered call option at $450, you're reducing your cost down to $188. And you're willing to give up the stock at $217.5 if you're a trader, or take in that additional income on a stock that doesn't pay a dividend. So that more or less wraps up our webinar, but one really powerful idea generating tool that I'd like to cover before we make you a very special offer. We won the Benzinga FinTech Award for Best Ideas Platform. Benzinga has been doing this for 3 years now. Josh Brown hosts these in New York. And we won it because of a platform called our Discovery Engine. This is a great way to generate ideas. In this case, on the last webinar we did with Tony back in March, we seeded the Discovery Engine with Michael Kors, which had a bullish power gauge rating in the apparel group, mid-cap stock with strong free cash flow. Price was oversold. And we immediately got back 5 stocks, and the most similar match, same way that Netflix or Spotify find you ideas based on matching your recent activity, was Columbia Sportswear, COLM. The stock was $77.42 when we did this webinar with Tony just about 4 months ago, and it went from $77.42 to $91. So this is a real example of a stock we featured on a webinar. Again, not recommendations, but just examples of how to generate really powerful ideas with our stock discovery engine. And it's continued to perform that way. More recently, it suggested that you could swap out of Starbucks into Chipotle, which had a bullish rating finally after 2 years, and that's worked out spectacularly. So the stock discovery engine, and again, here's that bullish personality change with the first buy signal all the way back in November with the stock at 64, giving you that directional edge. So that's how Chaikin Analytics improves your options trading. It gives you the directional edge by combining fundamentals with technicals into a quantitative model, giving you the buy and sell signals for those timely entries. And then we've bundled in OptionsPlay, and thank you, Tony, for really great examples here to give you the high probability options trade. So Chaikin Analytics, proven stock selection system with OptionsPlay ideas, normally sells for $2,195 for an annual membership. As a webinar special, we'd like to take $300 off the price of the subscription, reducing it to $1,895 a year. You can go to chaikinanalytics.com/options, and this offer expires Friday at midnight. Or you can call 877-697-6783, and I know Josh is going to put up a link to our fulfillment page in the chat box. Now, Chaikin Analytics comes with the 20-factor power gauge model, the stock discovery engine, our screening tool, and the options plays ideas that Tony has shared with you, and our intraday charts, our earnings alert, and my weekly market insights newsletter with a bullish or bearish stock of the week. Now, Jim Cramer, who has become an advocate of Chaikin Power Gauge after following Chaikin Money Flow for over 20 years, said, when I was on Mad Money, I learned a long time ago not to be on the other side of a Chaikin trade. We were talking about Centene as a buy at 105 in the midst of the waterfall decline. Here's the newest feature of Chaikin Analytics, our printable charts that include not just the technicals and the power gauge, but the actual power gauge display, the earnings dates, the dividend yield. Print this chart out. Everything you need to know about a stock in one very attractive, easily printed chart that's not going to break your ink budget with that blue background on our normal charts. Finally, as a Chaikin member, you get member-only access to our weekly strategy webinar with our market strategist, Dan Russo. Unlimited coaching, including one-on-one coaching. This is a big difference between Chaikin and any other service out there. If you need coaching, we want to give it to you because we want you to succeed. And we have onboarding sessions 3 times a week, and if you need a one-on-one coaching session, we're happy to schedule it. Plus, you get my colleague Dan Russo's daily morning insights. He identified stocks like Philip Morris, Ambarella, Tremble as short candidates there, also has long ideas. So one final sweetener. If you subscribe by midnight tonight, we'll take an additional $100 off the cost of Chaikin Analytics, reducing the cost to only $1,795 a year. Plus, if you subscribe by midnight tonight, we'll schedule a one-on-one phone conversation with me at your convenience once you've learned the system. These have been really educational for our members and also for me. So with that, I'd like to thank Tony Zhang. I got your name right this time, Tony. It only takes me 2.5 years. Finally get it right. For some really insightful options ideas and for creating OptionsPlay, which we really are proud to have bundled into Chaikin Analytics.
Thank you, Mark, and thank you everyone for joining me this afternoon. I hope you guys have found this useful.
So I'm going to hand it back to Josh Minlin, who will wrap up the webinar with a little bit of housekeeping.
Thank you, Tony, and thank you, Mark, for your time this evening. Thank you, everybody, for attending. To take advantage of the offer that Mark made and to get a one-on-one with Mark, which is an incredible opportunity, you can go to www.chaikinanalytics.com/options, or you can call us now at 877-697-6783. We can have you on an onboard session and up and running on our platform as early as tomorrow, and in one-on-one sessions with our client success team shortly thereafter. Again, the number to call, 877-697-6783, or go to www.chaikinanalytics.com/options. These are in the chat window right now, available for you. Thank you all. Have a good night.